The skyline still glows like nothing has changed. Glass towers reflect the desert sun. Sales offices stay open. Brochures still promise waterfront views and effortless returns. But behind closed doors, something far more urgent is unfolding. Meetings that don't make headlines. Calls that stretch late into the night. Lawyers, lenders, and executives sitting across tables, not discussing expansion, but survival. Not growth, but time. Because when a top Dubai developer enters emergency debt talks, the story isn't about one company anymore. It's about a system being tested from the inside. Billions in liabilities, payment schedules tightening, cash flow no longer matching ambition. And the most dangerous part? None of it looks like collapse. Yet, it looks controlled, managed, quiet, which is exactly how pressure hides. So the real question is not whether Dubai's biggest developers are in trouble. The real question is far more uncomfortable. What happens when a city built on continuous expansion starts negotiating with its own future just to keep moving forward? Dubai sold a promise that was hard to resist. Buy into the future, invest in growth that never pauses. Towers rise, demand follows, prices climb, and everyone wins. That belief didn't come from nowhere. For years, it worked. Mega developers expanded across residential, commercial, and hospitality sectors at a pace few cities could match. Projects launched before the previous ones were fully absorbed. Capital flowed in from every direction. International investors, banks, private wealth. The system was built on momentum. As long as sales continued, as long as demand held, debt wasn't a threat. It was a tool, a way to build faster, scale bigger, dominate the skyline. And that's what made Dubai different. It didn't grow cautiously, it grew aggressively. But aggressive growth has a hidden rule. It only works when conditions stay favorable, when buyers keep buying, when lenders keep lending, when confidence remains untouched. The moment that rhythm changes, the same system that accelerated growth begins to amplify pressure. And that is exactly where the shift begins. At first, it doesn't look like a crisis. It looks like adjustment. Payment timelines extended, contractors renegotiated, project phases delayed slightly, language stays calm, carefully chosen. Restructuring, optimization, strategic review. But behind those words, the reality is sharper. Cash flow begins to tighten. Sales slow just enough to create gaps. Costs, especially construction, labor, and financing, remain high or increase. And suddenly, the equation that once worked smoothly starts producing friction. Developers don't stop building. They slow, they reposition, they try to bridge the gap. But when debt obligations remain fixed and incoming cash becomes less predictable, pressure builds quietly. Then the signals become harder to ignore. Emergency talks begin, not optional, not proactive, necessary. Lenders want clarity, developers want time, and both sides understand something critical. If the structure breaks suddenly, everyone loses. So they negotiate, extend maturities, restructure liabilities, adjust terms, buy time. Because in Dubai's system, time is everything. Time to sell units, time to recover confidence, time to avoid the one outcome nobody wants to say out loud: default. The scale of the issue is what makes it impossible to ignore. We're not talking about small debts, we're talking about billions. Large developers operate with layered financing, bank loans, bonds, private funding, off-plan sales tied to future delivery. Each layer depends on the others functioning smoothly. If sales slow, cash inflow weakens. If construction delays increase, costs rise. If interest rates climb, debt servicing becomes heavier. These are not isolated pressures, they stack. And when they stack, even a strong developer begins to feel strain. The numbers begin to shift. Debt-to-equity ratios stretch. Liquidity tightens. Payment schedules become harder to maintain without adjustment. That's when restructuring moves from option to necessity, not because the company is collapsing, but because the model itself requires recalibration. The danger is not in one missed payment. It's in the system becoming less flexible under pressure. Because once flexibility is gone, every new challenge hits harder, every delay costs more, every negotiation becomes more urgent. The system that created this pressure is not broken. It's working exactly as designed. Dubai's development model thrives on leverage. Build big, build fast, use future revenue to support present expansion. It's a forward-driven machine, but that machine assumes continuous motion, continuous demand, continuous access to capital. When those conditions change, even slightly, the entire structure needs to adjust. And adjustment in a leveraged system is never simple. It requires coordination between multiple parties. Developers, banks, investors, contractors. Everyone must agree on new terms, new timelines, new expectations. And that takes time. Time that the system doesn't always have in abundance. Because while negotiations happen, obligations remain. Payments are due. Projects must continue. Reputation must be maintained. This is the balancing act. Keep the image stable while the structure is being reshaped underneath. And in Dubai, image is not secondary, it's critical because confidence drives investment, and investment drives everything else. The breakdown doesn't arrive as a dramatic collapse. It arrives as a shift in behavior. Developers become more selective about new launches. Marketing changes tone. Incentives increase quietly. Payment plans stretch longer. These are not random decisions. They are responses to pressure. Inside the company, priorities shift. Debt management becomes central. Cash preservation becomes critical. Expansion becomes cautious. The goal is no longer to grow at maximum speed. The goal is to stabilize, to maintain operations without triggering panic, because once panic enters the system, the consequences multiply. Buyers hesitate. Investors pull back. Lenders tighten conditions. That's why restructuring talks are not signs of immediate failure. They are attempts to prevent it. But they also reveal something important. The system is no longer running effortlessly. It's being managed actively, carefully. And that difference matters more than it seems. The human impact sits just below the surface. Buyers who invested in off-plan properties begin to worry about delivery timelines. Not panic, but concern. Contractors face delayed payments, forcing them to manage their own cash flow more tightly. Workers feel the pressure indirectly through slower project execution or reduced expansion. Even employees within these companies experience a shift. Uncertainty replaces confidence. Meetings change tone. Conversations become more cautious. This is how economic pressure moves through a system. Not through headlines, but through behavior, through decisions made quietly. And for a city like Dubai, where real estate is not just an industry, but a foundation of growth, these human responses matter. Because perception shapes reality. If confidence weakens, demand follows. And if demand slows, the pressure intensifies. There are deeper layers driving this situation. Interest rates globally have risen, increasing the cost of borrowing. That alone changes the economics of large-scale development. At the same time, construction costs remain elevated due to supply chain pressures and material pricing. Add to that shifting buyer behavior. Investors are becoming more cautious, more selective. The days of rapid speculative buying are less predictable. Then there's regional competition. Other cities are investing heavily in real estate and infrastructure, creating alternatives for capital. These factors don't operate independently. They converge. And when they converge, they compress margins, reduce flexibility, increase risk. The system becomes tighter, less forgiving. And in that environment, even strong developers must adapt quickly or face consequences. Globally, this pattern is not unique. Real estate cycles follow similar rhythms across cities: rapid expansion, peak confidence, gradual pressure, adjustment. We've seen it in New York, London, Hong Kong. The difference in Dubai is speed. The city moves faster, expands faster, which means pressure can build faster too. But it also means adjustment can happen faster, if managed correctly. That's the critical point. This is not a collapse story. It's a stress story. A system under pressure, trying to rebalance without losing momentum. And how that balance is managed will define what happens next. The realization is simple, but difficult to accept. Dubai's growth model is not failing. It's being tested. The emergency debt talks are not the end of the story. They are the signal, a signal that the system has reached a point where adjustment is necessary, where assumptions are being challenged, where growth must be aligned with reality, not just ambition. And in that moment, everything becomes more fragile, not broken, but sensitive, because the next phase depends on decisions being made now, quietly, behind closed doors. So, here's the question that matters. When billions are being renegotiated behind the scenes, what does stability really mean on the surface? Is Dubai still expanding, or is it carefully holding its position while pressure builds underneath? Tell me what you think. Is this just a normal cycle of growth and adjustment, or the early signs of something deeper? And if you want more investigations that go beyond the headlines and into the systems shaping the future, stay with me. Because the biggest shifts rarely happen in public. They happen in meetings no one sees.